Welcome to this, our first seminar on Bourse Brazil Latin Fund. My name is Subhash Ramkilawan, Managing Director of Bourse Securities Limited. Bourse Securities Limited is the manager for the Bourse Brazil Latin Fund. Today, we are going to cover several areas with regard to the fund. First, its historic performance. Then, as we all know, there have been some challenges in the LATAM space, and those challenges we have worked to deal with those challenges for the benefit of our unit holders. The presenter for today's Latin Fund presentation will be Sarod Ramkilawan, who is the manager investment for the fund. What we are going to do first of all is have the presentation, and then thereafter we are going to address questions which would have come up during the presentation. I invite each of you as investors and interested parties to send in your questions so that we can seek to address those questions as we go along. Let me now introduce you to the manager investment for the fund, Sarod Ramkilawan. Good day everyone, and again welcome to this webinar of Bourse Securities Limited, which will be focusing today on the Bourse Brazil Latin Fund and its performance and some considerations looking ahead for unit holders. On today's agenda, we will bring, among other things, some of the fund's highlights for the year thus far. We take a look at the performance both on a year-to-date basis as well as since inception. We consider the allocation of the fund, that is, how it is invested. We take a look at the market's performance in the Latin America region and the economic performance. And as unit holders who are following both the market and economy would realize there has been some considerable divergence in the economic and market performance of the region. Finally, we will take an outlook for the fund and consider some of the drivers of performance in the near and medium term, as well as some of the risks to performance in the near and medium term. And what are some of the investment management initiatives that are being undertaken to add the most value to unit holders. At the end, we will have a question and answer session, and it's important to note that we would appreciate if all attendees submit their questions throughout the presentation through the moderated chat, which will be collected by our investment and sales team, and we would be able to address these at the end of the session. So feel free to use the chat box that's available to submit your questions, and they would be anonymous, of course, and we would address the general questions in the Q&A session. And for more direct and individual questions which require personal attention, our team will reach out to you after the presentation. So let's get into it. In terms of the fund highlights, some good news for the year thus far. In 2016, the net asset value of the fund, as at yesterday's date, August 23, 2016, was US $8.16. Year to date, the fund has advanced 18.1%. What we have noted in 2016 thus far is the appearance of quite stronger markets, both in terms of equity and fixed income, despite weak economic fundamentals. External influences have played quite a role in shaping Latin American markets in the equity and fixed income space year to date thus far, and we expect that to continue. In particular, we are referring to US interest rate policy as well as commodity prices, and we'll discuss that in more detail as the presentation goes on. So let's now switch over to fund performance. In terms of In terms of fund performance, what we is that after a rocky start in early January and February, the fund and the Latin American region as a whole has enjoyed what can be considered quite a considerable rally in both equity and fixed income markets. And we would note that in late January / early February, the fund reached its lowest net asset valuation of just about $6.38 US dollars, and subsequently recovered to the $8.16 it is at the current point in time. And here we see the BBLF's net asset value since inception. And what we would note is that since inception, the fund would have peaked at just about positive 4% from the starting value of just about $10 per unit, and subsequently fallen to a low of about $6.38, as we mentioned, in early 2016, with a subsequent recovery to the $8.16 level. So some considerable volatility in the fund, and what we would notice is that the Latin American region, being predominantly comprised of commodity exporters, would have been somewhat correlated to the fortunes of commodities markets. And at its peak point, with a unit price of $10.40, it's important to note that oil prices at that time were just around $94 US per barrel, as per West Texas Intermediate. And at its low point of $6.38, West Texas Intermediate oil prices were just about in the $30 per barrel range. At current levels of $8.16, oil prices are hovering at just around $47 to $48 per barrel. In terms of its returns since inception, what we would note is that the fund has been relatively closely tied to the performance of its benchmark. And in 2013, we would have noted that the fund retained negative 2.7%, while its benchmark was down just about 5%. Similarly, in 2014, the fund would have reflected the benchmark's performance of around 8.5% decline. And in 2015, we would have taken a decision to adopt a much more conservative approach to managing the assets of the fund, whereby we felt economic fundamentals were deteriorating, and we would have moved to more fixed income and taken some cash positions, and that would have worked to the benefit of unit holders in 2015, whereby the benchmark would have declined just about 33%, and the fund would not have declined as much, but it was still down about 22%. In 2016, year to date, the fund is up around 18%, as mentioned, but the conservative approach would have worked against the favor of unit holders in this particular instance of a rising market, with the benchmark of about 43%. Now, to give some idea of the conservative approach, as opposed to just investing in the benchmark, yet since inception, if you had invested in the benchmark alone, you would have declined around 15.5%, and the fund in total is down about 17.5%. Let's take a look at the allocation of the fund, that is how the fund is invested at current point in time. And in terms of asset allocation, we would note, again, in line with the conservative approach adopted, equity and equity mutual funds account for just about 50% of the investments, while fixed income, which are predominantly US dollar denominated bonds, account for just about 30% of the investments. Cash and near cash comprise around 20%. Geographically, around 35% of the fund's invested portfolio is in the Brazil region, whereby 41% is in the other Latin America, ex-Brazil, which includes around 4% in Costa Rica, around 15% in Mexico, just about 8.5% in Peru, 7% in Chile, and around 7% in Colombia, respectively. The Caribbean, which are predominantly US dollar denominated bonds, account for just around 7%, as well as the non-Latin American region, to add some diversification to the fund, just purely being exposed to the Latin American region of about 16%. We switch to market and economic performance. And in terms of market performance on a year-to-date basis, what this chart would show is the impact of both currency appreciation as well as market advances in the equity markets. Overall, Latin America would have advanced in US dollar terms by about 84%. And this is the equity index we're referring to. And you would have seen similar advances across most of the major investing destinations in the Latin American region. So let's take Brazil as an example. In nominal terms or Brazilian real terms, the Brazilian equity market would have advanced about 54%. The doubly beneficial effect of an appreciation of the Brazilian real, that is the Brazilian currency, of about 22% year to date, would have contributed to an overall return in US dollar terms of about 64%. And the same sort of benefits could be seen both in Colombia, Peru, and Chile. In Mexico, however, despite an advance in nominal terms of the Mexican market, the currency has depreciated. The Mexican peso has deteriorated about 7.5%. Turning to the economic performance, so the market performance has been quite admirable. In terms of economic performance, Brazil is still in a bit of a challenging position. Growth in 2013 and 14 was quite moderate, particularly in 2013 where growth of just 3% was realized, and 2014 almost no growth. In 2015 we had economic contraction of almost 4%. And in 2016, the trend would suggest to most market forecasters that negative growth of about 3.3% will be achieved. In 2017, however, it is expected that there will be some modest turnaround or return to positive growth in the Brazilian economy of just about 0.5%. Interest rates, which have been exceptionally high to combat high inflation, have peaked at around 14.5%, and in 2016 this forecast, interest rates are forecast to drop to about 13.6% as we see some moderation of inflation in the Brazilian economy. Unemployment remains somewhat of a challenge, with the figure rising from about 6.8% in 2015 to just around forecasted figure at year-end 2016 of 11.3%. 2017 is not expected to be a much better year, with 12% unemployment expected. So to sum up, in terms of Brazil, the anchor investment destination of the Latin America Fund, economic performance remains muted. There will be weak GDP growth expected in 2017 and GDP contraction in 2016. High interest rates are expected to turn around, but are currently in place to combat the currently high levels of inflation, which are around 8.5%, and there is the trend of rising unemployment. Turning to Latin America as a whole, there's a similar trend. We saw in 2013 relatively cool growth for the region related to expectations of around 3.4%, and in 2014 just about 0.6% growth. 2015 and 2016 are and will be marked by a negative growth of about 0.4%, and 2017 there's an expectation of growth returning into the positive territory of about 1.5 to 1.6%. In terms of interest rates, again, because Brazil accounts for almost half of the Latin American economy, it would influence average interest rates in the region, and inflation would be affected to a large extent by inflation in both Brazil and the runaway inflation in Venezuela. Coincidentally, the fund does not have any investments in Venezuela for obvious reasons. Unemployment remains a characteristic across the region, with average unemployment peaking at around 10% forecast in 2017. So in summary, economic performance remains muted. inflation expectations are somewhat higher, though moderating to some extent in the Brazilian economy. And after expected GDP contraction in 2016, we do expect some modest rebound of growth in 2017. Now, in terms of our outlook and initiatives, there are several drivers of future performance which could move the net asset value of the funds up. And so let's take a look at Brazil first, and then we'll take a look at Latin America in general. With respect to Brazil, the new administration, which includes the new president, Mr. Michael Temer, will lead to increased investor and consumer optimism. Inflation, as we mentioned, is moderating, and it's coming down from a high of around 10% at the start of the year, or in February, to just around 8.5%, as we mentioned. Regionally and internationally, Brazil is still poised as a very important trade partner, particularly to the rest of Latin America, the US, and China. The country also has excellent access to international capital markets, as we would have seen in its recent auctions from the state-owned oil and gas company Petrobras, accessing markets relatively easily earlier this year. Brazil's debt to GDP level, as we will see, is also relatively moderate at around 68% or 67% debt to GDP. The Latin America region broadly will benefit from a recovery in commodity prices, as well as appreciation in its currencies, respective currencies. The Latin American region, ex-Brazil, also has relatively modest debt to GDP levels. And let's take a look at what we mean by moderate debt to GDP levels. In comparison to the US and Europe, who have inflation, debt to GDP levels of just over 100% and 90% respectively, what we will notice is that Brazil has a debt to GDP level of around 67%, Mexico of around 43%, Chile at around 17%, Peru 23%, and Colombia 38%. So there is the capacity to borrow to stimulate the economy, initiatives which have been undertaken by the European region and also by the US region in the recent past. So there is some scope for fiscal stimulus as well as monetary stimulus in the form of decreasing interest rates or cutting policy interest rates as inflation begins to moderate across the economies of the Latin American region. In terms of risks to future performance, with respect to the Latin American region as a whole, US interest rate policy and global growth uncertainty remain key contributors to risks in the performance of capital markets in the region. As we had mentioned earlier in the presentation, there are many exogenous factors which are influencing performance. With respect to US interest rate policy, a delay of US interest rate increases have partially contributed to a rally in equity and fixed income markets, while a commodity price rebound has also helped in that respect. However, global growth uncertainty, that is the US and Europe growing well below expectations, could temper this optimism in the near term for the Latin American and, by extension, global equity and fixed income markets. Should the US Federal Reserve increase US interest rate benchmark rates in the near term, it could lead to some level of instability in equity and credit markets respectively. And we saw that towards the end of 2015, with the first interest rate increase from the 0 to 0.25 region to 0.25 to 0.5% region by Fed Chair Yellen, it did result in some significant measure of volatility across global equity and fixed income markets. Specifically related to Brazil, new leadership at both the fiscal and monetary levels, with changes in both the leadership of the country and its central bank, may not immediately resolve economic performance. That is to say, a change in leadership is not necessarily a panacea for all economic woes. With respect to Mexico, economic fortunes are likely linked to the outcome of US elections, so we would await anxiously to see what those outcomes are. And finally, with respect to the China slowing growth story, this has an impact over the entire Latin America region, with China accounting for just around 40% or so of exports of Brazil, and a significant portion of export demand from the other Latin American countries. As we know, China is resource hungry, and it is in search of well-priced oil, natural gas, and other industrial metals such as copper, zinc, etc., all of which the Latin American countries produce and export to some degree. So, what are the investment initiatives as we close our presentation? And again, I would invite those who have not already submitted their questions via the chat to please do so that we may be able to address them during this live session, or if not, we will be able to reach out to you on a one-on-one basis and address these questions. Investment initiatives. With the economic outlook improving marginally, but still with the Latin American region not out of the woods as yet, and some market uncertainties rearing their heads towards the end of the calendar year 2016, we remain confident that a proactive and conservative approach to investment of the assets of the BBLF will be the best measure in the short term. In this regard, we are seeking a more balanced asset allocation, and as you would have seen, we have a greater weighting towards fixed income assets relative to what we would have had historically, with fixed income assets accounting for about 30% of the portfolio. We have reduced our exposure, our relative exposure to equities, with just about 50% of the fund invested in equity investments. And we have sought to actively minimize the currency-related risk, either explicitly by investing in assets denominated in US dollar currencies with little or no indirect currency risk to depreciating currencies of the region, or implicitly by investing in companies which earn most of their revenues in US dollars, while most of their expenses are in local currencies of their respective countries. And we have shifted the fund to focus mostly on yield by investing in more fixed income assets, so that we stabilize returns and also at the same time reduce volatility of the fund. So in closing, those are some of the initiatives that we have taken. We would have provided our outlook for the fund. We have discussed the allocation and how these are tied back into our strategies, tactics, and initiatives. And we would have summarized the performance of the fund year to date. And on that note, we would like to end the presentation and open the question and answer session of this webinar. So I would like to invite once again our Managing Director to join me as we address some of the questions which have been presented to us thus far. Why were the funds lower than expected? Well, I think that the presentation would have contributed somewhat to a better understanding of why the fund has not generated the kinds of returns that were first expected. When we started the fund in June 2013, mid-2013, by October 2014, we found that the world had slowed considerably.
And the impact was even greater than on LATAM, than even the Asian region. The impact mainly because, as the manager investment spoke, mainly because LATAM, those countries in which we are invested, Brazil, Colombia, Mexico, Chile, Peru, all of those countries as commodity producing countries would have been subjected to the deterioration in commodities, as Sarod would have mentioned, including copper, as well as oil and other commodities in the region. So we saw that downward movement, and as you know, as you would have seen, we moved to a defensive position, so that whereas the market went down to 32.9%, we were able to hold the position on the downward thrust to about 22%. Those are the main reasons for the performance of the fund today. The fund, as well as some of these economies, are in recovery mode. Not as much as the markets have gone. The markets have been somewhat disconnected to the economies in that the market has overshot in this year, and we've seen that recovery. But we are now seeing as well projections for recovery of the various economies, not least of which is Brazil. Although the recovery is not going to be stellar in many ways, it is certainly going to be a turnaround in terms of what has been experienced the two difficult years, including 2015 and currently 2016. So there are other factors, one of which was currency. The currency adjusted quite considerably, so that when we started the fund, the currency was somewhere in the region of about 205, 225 per US dollar. But the Brazilian currency deteriorated to as much as 4 real to the US dollar, so that we had some serious currency issues. However, the market as well went up, so you had a double whammy. The market has recovered, as well as currency recovering. So we are seeing the momentum back up to, from the nadir of the fund at $6.38 US, we are seeing the market back up to a level of $8.16, as has already been presented. All of this is dependent to some extent on commodity issuers. And we are seeing, and we have seen, that from the nadir of oil being in the high 20s, low 30s, has gone up to the $48 mark. That is what is responsible, and we can talk about what will happen or what we expect to happen going forward during this discussion.
Okay, we have another question. One of the questions posed was, when will the fund trade?
When will the fund trade? Well, as investors would know, we had listed this fund, your fund, on the Trinidad and Tobago Stock Exchange. And as the market slid down, there was some sort of freezing in trading on the exchange, such that you would have seen over a considerable period of time that the fund was listed at the last closing price on the exchange of $9.50, whereas the market, the net asset value of the fund, as differentiated from the listed price, was as down as low as $6.38. Investors will know as well that there is a trading band on the exchange outside of which you will not get trading happening. And that trading band is 15% up or 15% down. And if you take the $9.50 price and you take 15% down, it would be in the vicinity of where that 15% lower limit is now at the $8.16 or thereabouts. So that I expect that pretty soon you would see some sort of trading starting to come back on the market, so that investors will then have the opportunity to take a decision as to what they may want to do with their units. We strongly urge that in the recovery mode that investors consider holding on to their units, but in case of need, the market and trading is expected to resume based on where the price or where the net asset value per unit is for the Brazil Latin fund.
We have an additional question. The additional question is, what is the opinion on the political instability in Brazil in particular, and how will this affect future performance?
Okay. Well, I think that the political situation in Brazil has been rather startling over the past year and a half. The potential for impeachment of its then president Dilma Rousseff did roil the markets considerably, not only locally in the Brazil, which is the anchor of the Brazil Latin Fund, but also across the world. Then there were issues of corruption and in the mix that had an impact upon the markets. Over time, as would have been mentioned, there is now an acting president, Michel Temer, and there are some initiatives that have been already announced which we expect will contribute to recovery. A couple of them I would mention. One is the implementation of spending caps in terms of the fiscal situation, which will therefore limit expenditure by the Brazilian government and close the fiscal gap, which is the difference between revenue and expenditure to the government. Once that is narrowed, it would have a positive impact, as it already has in terms of confidence in the Brazilian economy. The restructuring of a pension program, which will also limit and minimize costs to the government for its public sector pension program. Then there is also the plan to amend industrial and labor regulations, which should have a positive effect and open up of the Brazilian economy to further foreign direct investments. So we expect that coming out of the political situation, there should be some economic benefits translated into market benefits. We feel that the weakest point is now behind us, and you are seeing recovery, and we expect continued recovery as the economy strengthens, and we can expect, or would expect, that it will dovetail into market performance.
And we received one more question. Please elaborate clearly the holdings of the fund and the percentage in US dollars versus Brazilian real.
Okay, well, Brazil, so you can probably pick up that from the graphs that you have presented.
Sure. So, as you would have mentioned, in terms of geographic allocation, about 35% of the fund is invested in Brazil. And in terms of the currency allocation, which was the part of the question, about 20% of the fund is invested in real denominated or assets with exposure to the Brazilian real. 27% of the fund, in terms of indirect currency exposure, is also invested in assets which have indirect exposure to other Latin American currencies. And as you would see in the graph, the other Latin American currencies include Mexico, Peru, Chile, and Colombia. The balance of the fund would be in US dollar denominated. Well, in US would have no exposure to currency fluctuation.
One other question is, when can investors expect positive growth? Well, we have been experiencing recovery, and the fund is at 816. Positive growth is dependent upon economic performance as well as market performance, and includes currency. All of these areas are certainly market and currency are uptrend as the currencies of LATAM are gaining momentum and are in quite positive territory this year. Markets as well have moved to positive territory measured in US dollar terms. Economies strengthening from a weak position in 2014 and 2015. So I can, based on these trends, we can see a moving into positive territory, as we have seen positive growth from the low point in 2016 as well. Let's see what are some of the other questions which have come up in terms of the fund trading, the fund's returns, positive growth, the political situation, the question of the fund's performance. These are some of the areas that we have been able to address with you. As we've said before, if there are any questions which you want to have answered one-on-one, please send to our email, and that email we'll put up on the screen so that you can send on email invest@boursefinancial.com or sales@boursefinancial.com. And of course, you can phone into us at 628-9100. Just some more perspective and color on the Bourse Brazil Latin Fund. Essentially, we went into this fund to give exposure to the Latin American region. We have exposure now to the Latin American region. Performance has been muted, but we are seeing the signs, significant signs of recovery getting in the Brazil area. So that investors, as I said, the choice is whether to stay or to exit, both of which routes are open to you as the fund starts to trade on the Trinidad and Tobago Stock Exchange, which we expect will happen soon. Now, you as investors have already seen, we at Bourse as well are investors. So we share the challenges that impact the fund. But we've seen the low point of the fund, and we've seen many of the recovery indicators for the fund. It was, when set up, a medium-term fund which allows exposure for a Trinidad and Tobago investor into the Latin American region. This has been done. The performance has been, albeit not as high as we would have expected, and therefore our position would be to stay in the fund as the momentum starts to build back up again. The world itself finds itself in very, very muted economic conditions as well as market conditions. So that in terms of building portfolio, this should be, the Latin American region should be a part of your international investment exposure, including Asia. As you know, we have the Save Invest India Asia Fund, including the US, including at the right time, Europe. All of these have to be taken into account in building a portfolio to making sure that your hard currency investments really work for you. Sometimes parts of the equation will be downwards and sometimes they will be upwards. But if you have a portfolio, by not having all of your eggs in one basket, you do have the opportunity for upside. Timing is another consideration, but who can predict timing? If you, in the context of, if you were to pick the bottom and invest in February 2016, you would have been about 65% up in US dollar terms in the Brazil region. But no one can really pick the bottom, So the moral of the story is to stay invested and stay diversified. Those are some of the issues that we feel we will have to address as we go forward in terms of building the fund.
Okay, so we're getting a couple additional questions coming in. So we will just wait to get those questions and we'll be able to address them. In the meantime, feel free to continue submitting your questions, and a reminder to some of those investors who also have investments in the Save Invest in the Asia Fund that we will be having our webinar tomorrow at the same time, 2:30, and you would have already received your invite. If you did not and would wish to receive an invite to that webinar, please again email us at invest@boursefinancial.com or sales@boursefinancial.com.
Yes. So speaking to the challenges or some of the challenges that we will continue to face in the international economy. Well, investors have seen what would have happened and issues relating to Brexit. Investors would have seen Asia start to recover. Investors would have seen and are particularly concerned about the question of when will interest rates in US dollar terms go up? Meaning, when will the Fed raise their policy rates? And those are issues that are critical to any hard currency fund, as is the Brazil Latin fund. Just a few thoughts on it. One is that there have been a number of reports of weaknesses across the world, and this has deterred somewhat the increase in the US policy rate. Let's see what will happen going forward. What is currently the probability in terms of an interest rate hike by December?
The most likely point, it's around, and don't quote me on this, but it's around 20%, I believe. But we could always get the actual figure and provide it to the unit holders.
Other questions?
Yes, so we did receive 3 questions. The first of which, in the graph, what is the difference between the benchmark returns and the BBLF? So I will just quickly switch to the benchmark returns and the BBLF. Right. So the difference between the benchmark and the BBLF would have been about 25% difference in 2016 year to date. Since inception, however, if you were to take a cumulative look at all these returns, the benchmark would have been down year to date about 15.5% or thereabouts, and the fund itself would have been down about 17 or 17.5%. Related to that question is, why isn't the fund invested more in Latin American countries than Brazil, seeing that Brazil, the country, isn't doing well anymore? And that's an excellent question. And so let's refer to that. And in terms of our geographical allocation of the invested portfolio, you would note, investors would see here that currently we are about 35% of the invested assets are in Brazil. Now, we recognize that Brazil isn't doing as well as it should be doing, and there are several headwinds to the Brazilian economy and market performance. And that's why, although we are invested in Brazil, it's not as much as the benchmark would be. So, for the benchmark investment in the Brazilian economy is around 53%, if I'm not mistaken, and we are currently at around 35%. So we would have taken what you would call an underweight position in the Brazilian market, which is invest less than the benchmark would invest, in an attempt to prevent any sort of value erosion which would come about as a result of investments in the Brazilian economy.
Well, I think just to add to that, it's a question of when you look at other international indices, the allocation to the various countries is really related to the size of the various markets. And whether we are above that allocation or below speaks to whether we are overweighted or underweighted. By far, Brazil is the largest economy in Latin America. So that whether we underweight or not, and we are underweighting because of the weak performance of Brazil in the last couple of years, even when we overweight in other jurisdictions, you would still see a smaller level of investment because we are weighting in accordance to the size of the various markets. We are also weighting in terms of the availability of US dollar investments in the markets and in issuers that are generating US dollars and the implications for investing with those pairs. Because you really still have to consider a hedge, whether a formal hedge or not. You still have to hedge against currency deterioration as well, or managing the currency impact on the fund.
And currency, just to extend on that point, currency, as we would have illustrated, has played a significant part in the good and bad fortunes of investments in the region. And as such, we're trying to reduce the volatility associated with currency-related risk and take more and focus more on the market-related risk by hedging or reducing our risk through the currency exposure.
Okay, so that should answer the question of why we are not invested in more Latin American countries. We are, in fact, invested, as shown on the graph that you see on the screen. We are invested in Mexico, Peru, Chile, Colombia, and Costa Rica. So we continue to invest. We want to make sure that investing, that there is good liquidity in those markets as well. And probably again, the best liquidity can be found in Brazil and Mexico. Beyond that, there are some limitations to liquidity in those various markets. So that will establish the bounds or the parameters for our investment into the LATAM market. Good. As Sarah mentioned, we are not invested in Venezuela for the simple reason that when we initiate investment into various jurisdictions, one of our internal guidelines is to invest in investment-grade countries at the point of investing. So we have had some fall-off in at least one of the countries in terms of falling below investment grade, but nonetheless, the investment is in a worthwhile jurisdiction. But we do not, at the point in time, invest in, at the point of investment, go into countries that might be B- or certainly not well below investment grade. It have to be at investment grade or near investment grade or above investment grade for us to invest. Most of the countries that we have listed here are at or better in terms of the minimum investment grade of S&P BBB-.
All right, and there was one more question so far. What is the relationship between the fund, and I assume that's the fund's performance, and oil prices internationally? That's a great question. So let's just go back to one of the graphs. Here we go. And we're taking a look at the BBLF net asset value since inception. And what we would note, as I had mentioned, is that it would appear that the Latin American countries are reasonably correlated to the performance of oil prices as well as other commodity prices. And other commodity prices here, we refer to copper, gold, iron ore, etc., zinc. And as I had mentioned, at the peak of the fund's net asset value, notwithstanding the challenges of slower growth in 2014 in Brazil and the other Latin American countries, the fund was at around $10.40 US. And at that point in time, as an example, which was around the 4th of September 2014, oil prices were around $95 a barrel. Copper was around $7,000 US dollars per metric ton. Iron ore was around $85 US dollars per metric ton, and zinc was around $2,400 a metric ton. to give an idea of how the BBLF would have fared in tandem with commodity prices at the $6.38 NAV, oil prices would have fallen almost 50%. Well, in excess of 50% actually, almost 60%, about $32 per barrel. Copper prices were down about 35%. And gold, well, iron ore prices were also half. They were just about 50% lower at around $41 per metric ton. So that is to say that there is some measure of relationship between commodity prices and as well the NAV of the fund, and that's because most of the countries that are in the Latin American region are commodity exporters.
Yes, and a very close correlation in terms of commodity price movement and the movement of the market, and by extension, your fund. So as we see prices go back up, it's a good signal, that is, prices for commodities. It is a good signal for the fund going forward. Any other questions so far?
So far, there seems to be none. Let me just take a look.
Okay. Well, if there are no other questions that you as the investor wish to field at this point in time, we will look forward to receiving any issues you may want to raise after the close of this webinar. This is a first for us in terms of reaching out to our clients, whereas before we have done it by way of seminars. We consider that it is good, and we will find out whether it is a more efficient approach to reaching to you as investors in the Bourse Brazil Latin Fund. So that being the case, reach out to us by phone, as we said, reach out to us by email, which you are seeing on your screen, and we will be very happy to answer whatever questions you have to raise post this webinar, and we will continue to keep you informed. So to you, our investors, we thank you for participation in this webinar. We invite you to continue to send in your questions so that we can keep you informed to the best of our ability. Have yourself a great day. This is Subhash Ramkalawan for Bourse Securities Limited and my colleague Sarod Ramkalawan as we sign off now.